Thank you. Yeah. Thank you. I didn't record this session, and I've said a lot of wonderful things. So. Is anybody recording in the background? Let me be sure. Anybody recording in the background? So that we can use your recording to.
No.
Ah, nobody. Okay. That's Paul. All right. So I said leverage is the ratio of the trader's fund to the size of the broker's credit. You can say that leverage is a borrowed capital to increase your potential returns. Leverage is a borrowed capital to increase your potential returns. Okay, so when you are picking a leverage size, you will see something like 1:100, 1:200, 1:500, 1:1000. So by my definition, 1 is the what? Ratio of the trader's fund to the size of the broker's credit. So yeah, for every, how do I define it now? For every one position you take or one trade you place, I think that will be the better definition. The broker will lend you 500 in credit so that you can trade that particular currency or trade that particular pair. So that's leverage. All right. Any other thing? Wow, I didn't want that session. That's cool. Yeah.
I want to get the point. What's the difference between the trader and the broker itself?
Okay. I defined broker. If you were here earlier on, please tell us what is a broker or who is a broker?
I met him.
Okay.
I actually met late. I joined the second.
Everett, is that you?
Yes, sir.
I don't want to ask the question.
Yes, sir.
It's fine. So I defined a broker. This definition is from my head now. You guys want to crack me up. That's what I was wanting for someone who was.
Served as a middleman.
Exactly. So a broker serves as a middleman between a retail trader and institutions. I think that's what I said, right? So
yes, sir.
And these brokers, they help you. They serve as a middleman to help you participate in trading the market. So you have various types of brokers. You have, let me list the ones that you will be familiar with: FXTM, Infinox, XNS, Hot Market. Have you hot? I've forgotten. You have
Octa effects.
Octa effects. I used to worry us on YouTube.
Derive.
Derive is more than a broker, but yeah, basically they are brokers. But then Derive, you have Hanko Trades, you have many, you have Swiss one thing. There are a lot of them. So these guys, they are said as middleman. They help retail traders like me and you to participate in the forex market. So they link up retail traders with institutional traders. Remember I told you that the people with money that move this market, that move this currency, is not me and you. It is institutions, people that have money, people that are trading. I think I said in our first class, the first time we met, that the forex market gives you a daily turnover of $6.6 trillion. $6.6 trillion. So you now that's coming to the market with your $500, they're going to slap you like. It will not affect, it will not shift, it will not move one spread, one peak there. It's not moving, right? So that's where leverage comes into, right? So the leverage allows that your small money to be quoted in a higher figure so that you can participate in the trading. Do you get? So when you're saying 1:500 for leverage, what's actually there is more than that your $500 or whatever dollars you are using to participate in the market, right? So that's how it works. So that's the definition of broker. Okay. Any question? it's as if there are some things I've not told you guys so in terms of Forex terminologies. I'm trying to wrap my head around a lot of things.
I've had some.
Hello, you want to ask a question?
No, go on, sir.
Okay, hedging, right? Hedging means hedging is defined as maintaining a market position, right? Which kind of secures the existing open position in the opposite direction. So hedging is maintaining a market position which secures the existing open positions in the opposite direction, which means you have placed the buy. I remember there was one time I used to do hedging. God. And I was good at it because let me explain. Hey, if you guys are seeing it now, you understand what I'm saying. So let me use this chart now to explain what I mean by hedging. So in hedging, right? So let's say you place a buy. Let's say you are here. Let me zoom in a bit. Someone trying to enter. Okay, no. Let me zoom in a bit. Let me use the next 4 minutes to explain hedging. So look at this candlestick, this bearish candlestick, this one where my mouse is, right? And you in this previous candlestick, before this one opened, let's say your anticipation as soon as this one opens, you buy. And then you place a buy. And then the market now sells. In your MT4, right? Let's say your MT4 is reading -$2. Remember, you placed the buy and it's reading -2 because the market is selling. I will now immediately place a sell in the opposite direction. So my sell will probably be running a profit of 0.5 cents, half a cent, half a dollar, or $1. So I'm losing on my buy side -2. On my sell side, I'm gaining +1. Then in the total profit or loss, I'm actually losing 1, right? Because I was losing 2 and I placed a trade in the opposite direction. So I gaining 1. When you do the math, I'm losing 1. But then now the market now continues to go up. It means my sell guy will be reading negative. My buy guy will be increasing now in positive. But your view is once you get to a particular position, it will reverse to your sell, which means once the price get here, you close your buy and leave your sell active or add more sells at this level and keep on selling down. For those of us that are new, this is dangerous. I should not be teaching you this, but that's how sometimes you try to cover up your losses when the market wants to joke with you. You now decide to play with the market too. You hedge by maintaining a market position which secures the existing open position, but now in the opposite direction. Now, a flat market is a market that is characterized by low volatility or low volume. That means what I mean low volatility, I mean like a movement. You can almost call it a ranging market. It's flat market, right? It's flat. Okay. All right. So I mean we have 2 minutes. So is there any question? Because by the time we're coming in again, we are going to be doing risk management. Any question on Forex terminologies? When you proceed, you begin to understand more in terms of terminologies and their explanation. Any question?
Please, can you come again with this flat market?
Okay, I said a flat market can, I said a flat market can is a market that is characterized by low volatility.
Okay.
Is that the word I used? Is it volatility or liquidity?
Volatility.
Is that the word I used in first place? Because I'm saying this from my
yes.
Okay. Yeah. Okay.
You haven't explained volatility before.
I did now in the first session. Did I not?
Or you did not. Can you explain liquidity?
Oh, okay. Okay, so let me explain volatility. So volatility is the measure of the amount by which price fluctuates in a given period. I will explain, just write that one. A measure of the amount by which price fluctuates over a given period. So it is simply a measure of how there are more upside or downside for a particular currency pair within a particular period. I think that's a better definition, right? So it's a measure of how large there's upside or how large there's downside for a particular currency pair within a particular period. So when you hear gold is a very volatile pair, it means the measure of upside or the measure of downside for gold, right, is very large. So take for example, I think there are days where, oh my God, we'll soon go off. Let me very quick. There are days where gold will give you, let's say 320 pips. But in some currency pairs, you see 45, 100 and something. So we see that gold has a large amount of either upside or downside. Okay, is a measure of how large the upside or downside for that particular currency is in terms of price. Okay, I believe there are no questions because we have less than 1 minute. When Zoom takes us out, I'll send in a link. You join in so that we can start risk management class. Understood. Thank you. Let me just end it.